On Cerner, we expect them to have a really weak quarter. If we're right on their short call, and I know a lot of you listening are pretty familiar with it, it's going to happen this quarter, mainly because we're facing the most difficult bookings comp. It's a very similar setup to what we had when we first put the short on in September last year, heading into one of the most difficult bookings comparisons in the year. Management did guide to +7%, -7% year-over-year bookings growth. That's a really wide range, and given that you could have deals in there that are $100, $200 million, if one slips, it really hurts with your giving visibility to the street. But let's get into it. So the core of our thesis here is really that there's just not enough EHR replacement activity left to sustain bookings growth. What you can, on this chart shows the historical U.S. hospital market share by net patient revenue, so it's a good proxy for the size of the underlying hospital. A 25-bed hospital from a booking perspective not being equivalent to that of a 300-bed hospital. And it really what goes to show is just the rise of Epic and CERN over this period, especially Epic. I mean, it's Epic. And over this period, Cerner and Epic are accruing about 90% of the licensed bed share that turns over. What is really interesting, if we think about a replacement market that really started to heat up in 2011 after stimulus dollars really did peak, is that some of these legacy vendors saw their install base shrink by 80 to 90%, especially with GE Healthcare, some proprietary systems, and McKesson. On slide 20, it's showing the same thing, but just kind of hammering the point home a little bit more. Looking at the change over this period, you really see that there was $283 billion in net patient revenue turning over this period, over this time, or 6 years. Most of it, again, accruing to Epic and Cerner's Millennium product. That's there. MedHost got a little bit, but that's just because they're unique, because they're basically the go-to system for part of community health. But the real key point here is that when we look at what drove the replacement activity over this period, it was really other McKesson, Siemens, and McKesson has no more market share to give. The other category has consolidated. Siemens has very limited share left to give as well, so we just don't see how it's sustainable going forward. So bringing it all together on slide 21, when we look at the current share, we basically have $220 billion in net patient revenue remaining in the EHR market. This is compared to $283 billion in net patient revenue that turned over this period. So at its most basic level, there's just not enough market opportunity left in the next 5 years to replicate what we've seen in the last 5 years. Plain and simple. So how can any of these EHR companies grow unless if they're really starting to enter new markets like Athena is on inpatient? And this even includes, that 220 includes HCA, which is one of the largest Meditech install bases. So if we assume that they don't turn over, it's even smaller at $190 billion. And what's left is at the bottom end of the market, single hospital health systems that are cash strapped. And if they haven't made a decision, there probably is not a good catalyst for them to do so, at least at the same pace that we've seen. And most of them are small hospitals. So Cerner can pick up 5 critical access hospitals in a quarter, but it's still less than if they were to sign a 500-bed hospital or a 2,000-bed multi-hospital health system. If you don't believe us, we can just replicate management's numbers. We actually did this for a client using the HIMSS analytics database, which I'm sure is what management used as well, because when we do a side-by-side analysis, our numbers are essentially the same as for the number of sites. It's misleading. It's misleading to look at say that there's a highly active replacement market and say that there's 2,400 sites on a legacy acquired platform, because if there's 2,400 critical access hospitals on legacy platforms versus maybe there being 1,500-bed hospitals 5 years ago, clearly the market is a lot smaller today, and we can see that on slide 23, which shows that the 2017 legacy vendor market is a third of the size today as it was in 2011. So much smaller than even the $190 billion, which just doesn't bode well for new client bookings. And then finally, the pushback that we get a lot is on white space opportunity. Management uses this term a lot, which is basically saying that you have a great example on the right-hand chart. You see community health having less than 10% of their licensed beds on Cerner's platform, and that white space opportunity, that S-curve looking line, that's Cerner capitalizing, continuing to sell more and more of the community base. However, when we consolidate it, we look on the left-hand chart and we say, well, they're already 75% penetrated into Millennium hospitals that are committed to them. Can that go higher? Yes, but clearly it's slowing. And again, there's just not enough opportunity left going forward to sustain new client bookings growth, which is what we show on slide 25. So kind of bringing it all together and looking at the correlation between Cerner's new client commercial bookings. This is not the DoD, this is not the VA. This is commercial only. They do about $2 billion a year at the peak in 2015. It declined to $1.8 billion in 2016. And what the correlation suggests is that Cerner needs to capture $16 billion a year in net patient revenue. If we think that there's only $190 billion in net patient revenue left in the whole market, we assume that we look at the market and never more than 10% of the market has ever turned over in a given year. So that's 19 billion. So Cerner would need to capture essentially 100% of the entire replacement market. So all those decisions going all to Cerner in order to sustain new client bookings, at least based on this